The complete story of Founders Fund. In March of 2008, while Bear Stearns was collapsing and the financial world was gripping with fear, Peter Thiel sat in his San Francisco office making a different kind of calculation. Every investment bank on Wall Street was hoarding cash and pulling back from risk. Every venture capital firm was telling portfolio companies to cut burn rates and prepare for the worst. But Thiel saw something different. He saw the beginning of the greatest buying opportunity of his generation. Within weeks, Founders Fund would commit hundreds of millions to new investments. They would back SpaceX when NASA contracts seemed uncertain. They would invest in Palantir when government budgets were being slashed. They would fund companies that every other investor was avoiding. This wasn't recklessness. It was 20 years of preparation for exactly this moment. A philosophy forged through decades of contrarian thinking. A track record of seeing the future before anyone else. A willingness to stand alone when everyone else was running for the exits. While other venture capitalists asked how do we survive, Thiel asked what can we build? This moment revealed everything about what made Founders Fund different. They didn't just invest in technology. They invested in ideas that seemed impossible. They didn't follow trends. They created them. They didn't optimize for the next 18 months. They built for the next 20 years. This wasn't venture capital as the world knew it. This was something entirely new. The story of Founders Fund begins long before its official founding in 2004. It begins with Peter Thiel's journey from a childhood shaped by movement and intellectual intensity to becoming one of the most influential investors of his generation. Born in 1967 in Frankfurt, Germany, Thiel spent his early years moving between countries as his father worked as a chemical engineer. The family lived in South Africa and Namibia before finally settling in Foster City, California when Peter was in elementary school. This constant movement shaped Thiel's worldview in profound ways. He learned early that the world was bigger and stranger than most Americans understood. He saw different political systems, different economic arrangements, different ways of organizing society. While his peers in suburban California took American prosperity for granted, Thiel understood it was neither natural nor permanent. This global perspective would later inform his investment philosophy. He would always be looking for the next shift, the next transformation, the next paradigm that would reshape everything. Thiel was intellectually gifted from childhood. He competed in national chess tournaments, demonstrating the strategic thinking and several moves ahead planning that would characterize his later career. At Stanford University, he studied philosophy, drawn to questions about truth, reality, and the nature of progress. He founded the Stanford Review, a libertarian student newspaper that challenged the prevailing orthodoxy on campus. Even then, Thiel was comfortable being the dissenting voice, the person willing to argue positions that made others uncomfortable. After Stanford, Thiel went to law school, earning his degree from Stanford Law in 1992. He clerked for a federal appeals court judge, then joined a major New York law firm. By all conventional measures, he was on track for a successful legal career. But Thiel found law practice intellectually stifling and politically compromised. He lasted 7 months and 3 days at the firm before quitting. This would become a pattern in Thiel's life. He would try the conventional path, find it wanting, and strike out in a completely different direction. Returning to California, Thiel worked as a derivatives trader at Credit Suisse. He was good at it, making successful bets on currency movements and interest rate changes. But trading felt like a zero-sum game to him. For every dollar he made, someone else lost a dollar. There was no creation, no building, no progress. Just redistribution. Thiel wanted something different. He wanted to create value, not just capture it. The insight that would change Thiel's life came from watching the early internet emerge in the mid-1990s. Unlike most observers who saw the web as primarily a communications medium or information repository, Thiel saw it as a payment infrastructure waiting to happen. Cash and checks were 19th century technologies. Credit cards were mid-20th century. The internet needed a native payment system, something designed for the digital age. This insight would lead directly to PayPal. In December of 1998, Thiel co-founded Confinity with Max Levchin and Luke Nosek. The company's original focus was cryptography and security for handheld devices. But they quickly pivoted to an idea that seemed much simpler but was actually far more ambitious. They would let people send money via email. Just type in an email address, enter an amount, and instantly transfer funds. No banks, no wires, no delays. Money at the speed of the internet. The idea seemed straightforward. The execution was nightmarishly complex. They had to navigate banking regulations designed for brick-and-mortar institutions. They had to prevent fraud in an environment where criminals could attack from anywhere in the world. They had to scale infrastructure to handle millions of transactions. They had to compete with much larger, better-funded rivals. And they had to do all of this while burning through cash at an alarming rate. The story of PayPal has been told many times. What's less appreciated is how the experience shaped Thiel's later investment philosophy. At PayPal, Thiel learned that the best products often seem trivial or unnecessary at first. Sending money via email seemed like a solution in search of a problem. Existing payment methods worked fine for most people. But for a small group of eBay power sellers, PayPal was transformative. That small group became the wedge that opened the entire market. Thiel also learned that the best teams are mission-driven, not mercenary. The early PayPal employees worked 100-hour weeks not because they were getting rich on paper wealth, though some were, but because they believed they were building the financial infrastructure of the future. They were creating something that would outlast them. This sense of mission attracted exceptional talent and sustained the team through multiple near-death experiences. Perhaps most importantly, Thiel learned that contrarian thinking is not just about being different. It's about being right when the consensus is wrong. Throughout PayPal's history, conventional wisdom said they should do various things. Partner with banks rather than compete with them. Focus on consumer payments rather than merchant services. Accept slower growth in exchange for lower fraud. Thiel and his team did the opposite on all of these, and they were right. When eBay acquired PayPal in July of 2002 for $1.5 billion, Thiel received approximately $55 million from his ownership stake. More valuable than the money was the network he'd built. The so-called PayPal Mafia would go on to found or fund many of the most important technology companies of the next 2 decades. LinkedIn, YouTube, Yelp, Yammer, Tesla, SpaceX, and many others all had PayPal alumni in founding or early leadership roles. But in 2002, none of this was obvious. The dot-com bubble had burst. Technology stocks had lost trillions in value. Major internet companies like Pets.com and Webvan had collapsed. Venture capital returns were dismal. Many observers declared that the internet had been overhyped, that most of the opportunities had already been exploited, that the future would look a lot like the past with slightly better websites. Thiel believed exactly the opposite. He thought the bubble and subsequent crash had scared away most of the competition. Capital had become scarce. Valuations were reasonable. Talented people were available. The infrastructure had improved dramatically. Broadband was spreading. Mobile phones were getting smarter. Computing power continued to double every 18 months. The opportunities weren't disappearing. They were multiplying. But hardly anyone could see it. In 2004, Thiel formally established Founders Fund with 2 former PayPal colleagues, Ken Howery and Luke Nozek. The name itself was a statement of philosophy. Most venture capital firms were named after their founding partners, reinforcing the importance of the investor. Founders Fund put the entrepreneur first. The message was clear. We back founders, not ideas or markets or business plans. We bet on exceptional people building important things. The firm's initial fund was small by venture capital standards, just $50 million. But the terms were unusual. Most VC firms charged 2% management fees and took 20% of profits. Founders Fund took lower fees and higher carry, aligning their interests more closely with returns. They also had longer lock-up periods, giving them patience that other investors lacked. They weren't optimizing for the next fundraise. They were optimizing for the next decade. From the beginning, Founders Fund operated differently than other venture firms. Most VCs had large partnership meetings where investment decisions were debated and voted on. This led to consensus thinking and lowest common denominator choices. Founders Fund gave individual partners the authority to make investments on their own. If one partner believed in something strongly enough, that was sufficient. This created a portfolio of high-conviction bets rather than committee compromises. Most VCs focused on relatively safe investments in proven markets. Enterprise software, consumer internet, mobile apps. Things that were clearly working and just needed execution and scale. Founders Fund deliberately sought investments that seemed crazy. They wanted companies working on problems that most people thought were impossible. They wanted founders who were building the future, not iterating on the present. They wanted ideas that would either fail completely or change the world. This philosophy was crystallized in a 2011 essay Thiel published called What Happened to the Future. In it, he argued that technological progress had stalled in most domains outside of computers and communications. We were promised flying cars and got 140 characters instead. Innovation in energy, transportation, medicine, and materials had slowed dramatically since the 1970s. The world was stuck in what he called a great stagnation. Founders Fund's mission was to end that stagnation. They would back companies working on what they called frontier technologies. Rockets and spacecraft, nuclear fusion, artificial intelligence, biotechnology, nanotechnology, things that could fundamentally reshape human civilization. These investments had much higher failure rates than typical venture bets. But the successes could be orders of magnitude larger. This wasn't just about making money. It was about accelerating progress and expanding what was possible for humanity. The first major test of this philosophy came in 2004 with SpaceX. Elon Musk had recently sold PayPal to eBay and was using his proceeds to start two audacious companies. Tesla aimed to build high-performance electric vehicles when every previous attempt had failed. SpaceX aimed to dramatically reduce the cost of space access and eventually enable human settlement of Mars. Both ideas seemed completely insane to most observers. Thiel and Musk had worked together at PayPal, where their relationship was complicated. Musk had been CEO of X.com, which merged with Confinity to form PayPal. There was tension over strategy and control. But Thiel respected Musk's technical ability and ambition. More importantly, he understood Musk's gift for recruiting exceptional engineers and motivating them towards seemingly impossible goals. If anyone could revolutionize spaceflight, it might be Musk. When SpaceX came looking for investment in 2004, most venture capitalists wouldn't even take the meeting. Space was a graveyard for private capital. Every previous commercial space venture had failed. The capital requirements were enormous. The technical challenges were immense. The path to profitability was unclear. The usual venture capital playbook of quick iterations and pivots wouldn't work when you're building rockets. Why would anyone invest in this? Thiel saw it differently. The United States and Russia had proven that rockets could reach orbit. The physics worked. The question wasn't whether it was possible, but whether it could be done more efficiently. SpaceX had a specific plan to reduce costs by an order of magnitude through vertical integration and reusable rockets. If they succeeded, they would have a monopoly on low-cost space access. That monopoly could be worth hundreds of billions. The risk-reward was actually quite favorable. Founders Fund led SpaceX's Series A, investing $20 million in 2004. This was an enormous bet for a young firm with a small fund. They were putting 40% of their capital into a single company in an industry with zero venture capital success stories. Their limited partners thought they were crazy. Other VCs thought they were crazy. But Thiel had conviction based on his analysis of Musk, the technology, and the strategic opportunity. The investment almost immediately looked like a disaster. SpaceX's first 3 launch attempts all failed. Rockets exploded on the pad or shortly after liftoff. The company burned through cash at a terrifying rate. By 2008, SpaceX was nearly bankrupt. Musk was forced to choose between funding SpaceX or Tesla. Most investors would have written off the investment and moved on. Founders Fund not only held their position, they invested more money in the Series C. The fourth launch attempt in September of 2008 succeeded. Falcon 1 reached orbit, becoming the first privately developed liquid fuel rocket to do so. More importantly, it demonstrated that SpaceX's approach worked. They could build rockets cheaper and faster than traditional aerospace companies. In December, NASA awarded SpaceX a $1.6 billion contract to resupply the International Space Station. The company was saved. The investment was saved. And the future of commercial spaceflight was fundamentally altered. But SpaceX represented more than just a successful investment. It validated Founders Fund's entire philosophy. The best opportunities look crazy at first. The best founders are obsessively focused on problems everyone else has given up on. The best investments require conviction when others are fleeing. The best returns come from companies that are building genuinely new technologies, not iterating on existing ones. If Founders Fund had followed conventional venture capital wisdom, they never would have invested in SpaceX. And they would have missed one of the greatest venture investments of all time. The SpaceX investment also revealed something crucial about Thiel's worldview. He genuinely believed that technological progress had slowed and that this was both tragic and reversible. Most people accepted the Great Stagnation as inevitable. Thiel saw it as a choice, a failure of ambition and imagination. By backing companies like SpaceX, he wasn't just seeking returns. He was trying to restart technological progress in domains where it had ground to a halt. This mission-oriented investing extended to Founders Fund's other early bets. In 2004, they invested in Palantir, a data analytics company Thiel had co-founded to help government agencies prevent terrorism. The technology was controversial, raising questions about privacy and surveillance. But Thiel believed it was crucial for national security. In 2005, they invested in Facebook, seeing it as the foundation for a new social infrastructure. In 2006, they backed Spotify before streaming music seemed viable. Each of these investments reflected Founders Fund's core principles. They were backing founder-led companies with bold visions. They were investing in technologies that could scale to billions of users or trillions in value. They were comfortable with long-time horizons and high uncertainty. They were willing to be misunderstood by peers and criticized by observers. They believed the future would be radically different from the present, and they were positioning to profit from that difference. The 2008 financial crisis was a defining moment for Founders Fund. While the rest of the world was panicking, Thiel saw opportunity. Credit had dried up. Competition had disappeared. Valuations had collapsed. Talented people were available. This was exactly when you should be investing aggressively. Founders Fund deployed capital at an accelerated pace in 2008 and 2009, making some of their best investments during the depths of the crisis. This contrarian approach extended to their view of financial markets. While other investors were selling everything and moving to cash, Founders Fund was analyzing which sectors and companies were genuinely impaired versus which were simply caught in an indiscriminate sell-off. They distinguished between companies with broken business models and companies with solid businesses facing temporary liquidity problems. This analytical framework allowed them to invest with conviction when others were paralyzed by fear. The crisis also reinforced Thiel's view that most investors are driven by social proof rather than independent analysis. When things are going well, everyone wants to invest. When things are going badly, everyone wants to sell. This herd behavior creates the very opportunities that contrarian investors exploit. The key is having the psychological fortitude to act when your instincts and your peers are telling you to do the opposite. Thiel had developed this fortitude over decades of going against the grain. By 2010, Founders Fund strategy was producing extraordinary results. Their early bets on Facebook, SpaceX, Palantir, and others were paying off. They were generating returns that put them among the top-performing venture firms in the world. More importantly, they were demonstrating that their unconventional approach worked. You could invest in crazy-sounding companies working on hard problems and make exceptional returns. You didn't have to follow the herd. The success attracted attention and capital. Founders Fund raised larger funds, eventually managing billions of dollars. They expanded the team, bringing in partners who shared their philosophy. They opened offices beyond San Francisco. They invested internationally. But as they scaled, they faced a challenge that had destroyed many successful venture firms before them. How do you maintain your edge as you get bigger? How do you stay contrarian when you become the establishment? Founders Fund addressed this through their partnership structure. Unlike most VC firms where partners share carry across all investments, Founders Fund partners keep carry from their individual deals. This creates strong incentives for conviction and removes the pressure to convince your peers. If you believe in something, you invest in it, and you live with the consequences. This structure ensures that growth doesn't lead to consensus thinking and mediocrity. They also maintained their focus on frontier technologies even as other firms chased consumer apps and enterprise software. In 2012, they invested in Airbnb when many observers thought the home-sharing model would face insurmountable regulatory challenges. In 2013, they backed Stripe when many saw payments as a solved problem dominated by PayPal and Square. In 2014, they invested in Wish when most investors thought e-commerce innovation was over. One investment that exemplified Founders Fund's approach was their bet on synthetic biology companies. In the early 2010s, they backed multiple companies working on using biology as a manufacturing platform, turning cells into factories that could produce fuels, materials, medicines, and food. This seemed like science fiction to most investors. The technology was unproven. The path to market was uncertain. The capital requirements were enormous. But Founders Fund saw it as the next frontier of manufacturing. These synthetic biology investments had mixed results. Some companies succeeded and became billion-dollar businesses. Others failed and returned nothing. But the approach illustrated Founders Fund's philosophy. They were willing to make multiple bets in an emerging field, knowing that most would fail but the winners could be enormous. They were thinking about what the world would look like in 20 years, not what it looked like today. They were backing technologies that could fundamentally reshape industries, not just improve them incrementally. Another defining investment was their backing of crypto and blockchain companies starting in 2013. Thiel had been skeptical of Bitcoin initially, dismissing it as a libertarian fantasy. But as he studied it more deeply, he came to see it as potentially revolutionary. Not necessarily Bitcoin itself, but the underlying idea of trustless digital systems. This could enable new forms of money, new types of organizations, new ways of coordinating human activity. Founders Fund invested heavily in the crypto ecosystem over the next decade. They backed exchanges like Coinbase. They funded blockchain infrastructure companies. They invested in decentralized applications. They bought Bitcoin and other cryptocurrencies directly. This wasn't a consensus position. Many respected investors thought crypto was a scam or a bubble. But Founders Fund saw it as the next phase of the internet, moving from information exchange to value exchange. The crypto investments were extremely volatile. Prices would surge and crash repeatedly. Companies would pivot or shut down. Regulators would propose restrictions. Critics would declare crypto dead multiple times. But through it all, Founders Fund held their positions and continued investing. They believed the technology was real and important, even if the path forward was unclear. This long-term conviction in the face of volatility was characteristic of their entire approach. By 2015, Founders Fund had established itself as one of the most influential venture firms in the world. They were known for backing ambitious founders working on important problems. They were known for their willingness to invest in companies and technologies that others thought were crazy. They were known for their analytical rigor and contrarian thinking. And they were known for producing exceptional returns. But success brought new challenges. As the firm grew wealthier and more established, would they lose their edge? Would they become more conservative and consensus-driven? Would they start optimizing for safety rather than impact? These were questions that had destroyed many successful venture firms before them. The founders who had taken bold risks with their first 100 million became cautious stewards protecting their next billion. Thiel was acutely aware of this danger. He had seen it happen to other investors and institutions. Success breeds complacency. Wealth breeds risk aversion. Establishment status breeds conformity. The very things that made you successful become the things that destroy you. Avoiding this trap required constant vigilance and a commitment to first principles thinking. It required remembering why you started in the first place. One way Founders Fund maintained their edge was through their hiring. They didn't just look for people with venture capital experience or prestigious credentials. They looked for people who had started companies, built products, or worked in frontier technologies. They wanted partners who understood the challenges of building something new, not just analyzing someone else's pitch deck. This approach brought in people like Brian Singerman, who had founded a company before joining Founders Fund, and Cyan Bannister, who had founded multiple startups. They also maintained their focus on what they called definite optimism. This was Thiel's framework for thinking about the future. Definite pessimists believe the future will be worse and prepare accordingly. Indefinite pessimists don't know what will happen but assume it will be bad. Indefinite optimists believe the future will be better but don't know how, so they optimize for optionality. Definite optimists believe the future will be better and have a plan to make it so. Founders Fund positioned themselves firmly in the definite optimist camp. They had specific visions for how technology would evolve. They made concentrated bets on companies executing those visions. They weren't hedging or diversifying broadly. They were going all in on their highest conviction ideas. This approach led to a portfolio that looked nothing like other venture firms. Where others had dozens of similar-looking enterprise software companies, Founders Fund had rocket companies, nuclear fusion startups, and artificial intelligence research labs. This approach was vindicated again and again. Their investment in Oscar Health, a technology-driven health insurance company founded in 2012, reflected their belief that healthcare was ripe for disruption. Their backing of Wish showed conviction in a new model for e-commerce. Their support for Anduril Industries, a defense technology company, demonstrated their belief that American defense capabilities needed upgrading. Each of these bets was controversial when made. Each reflected deep thinking about where the world was headed. The rise of artificial intelligence in the 2010s presented both opportunity and risk for Founders Fund. On one hand, they had invested early in AI companies and understood the technology's transformative potential. On the other hand, Thiel was concerned about AI safety and the possibility that advanced AI could pose existential risks to humanity. This tension between technological optimism and concern about unintended consequences would define much of Founders Fund's thinking in the 2010s. They addressed this by investing in AI companies they believed were approaching the technology responsibly while also funding research into AI safety and alignment. They backed DeepMind before it was acquired by Google, recognizing the talent and ambition of the team. They invested in OpenAI's early rounds, supporting their mission to develop safe artificial general intelligence. They funded companies working on AI applications in specific domains like healthcare and materials science. But they also maintained skepticism about AI hype. Many companies were labeling themselves as AI when they were really just using basic machine learning. Many investors were chasing anything with AI in the name without understanding the technology. Founders Fund tried to distinguish between genuine breakthroughs and marketing buzzwords. This required technical depth that many venture investors lacked. The Trump presidency from 2016 to 2020 was a complicated period for Founders Fund. Thiel had been a prominent Trump supporter, speaking at the Republican National Convention and donating significantly to the campaign. This was controversial in Silicon Valley, where opposition to Trump was nearly universal. Many entrepreneurs and investors criticized Thiel. Some refused to work with Founders Fund. The firm faced a backlash that other venture firms didn't. Thiel's political involvement reflected his broader worldview. He believed that American institutions were failing, that technological progress had slowed, that political correctness was stifling innovation, and that radical change was needed. Trump represented disruption of the establishment, even if his policies were inconsistent or problematic. Thiel was willing to be criticized and socially ostracized for his political beliefs, just as he had been willing to be wrong about investments. The political controversy didn't significantly impact founders' funds investing. They continued backing ambitious companies regardless of the founders' political views. They continued generating strong returns. They continued attracting deal flow. If anything, the controversy reinforced their brand as contrarians willing to be unpopular. Some founders appreciated their willingness to buck Silicon Valley consensus. Others avoided them. But they remained relevant and influential. The COVID-19 pandemic in 2020 was another crisis that revealed founders' funds' approach. While most investors panicked and pulled back, founders' fund accelerated their investing. They saw the pandemic as a catalyst for technological adoption and transformation. Remote work would accelerate. Telemedicine would go mainstream. Biotech would get massive new resources. E-commerce would capture more of retail. Digital infrastructure would become more important than physical. They invested aggressively during the pandemic, backing companies in all of these spaces. They also made personal protective equipment deals and funded vaccine research. Unlike some investors who sat on the sidelines waiting for clarity, Founders Fund was willing to act with incomplete information. They made probabilistic judgments about how the world would change and invested accordingly. This required courage and conviction at a time of maximum uncertainty. The pandemic investment spree generated mixed results. Some bets paid off spectacularly as the trends they identified played out. Others failed as the world returned to normal faster than expected in some domains. But the overall approach was vindicated. By acting when others were paralyzed, they got access to opportunities at favorable valuations. By thinking clearly about second-order effects, they identified non-obvious winners. By maintaining conviction, they avoided panic selling at the bottom. As Founders Fund entered the 2020s, they faced a venture capital landscape that had changed dramatically since their founding. Valuations had inflated massively. Competition for deals was intense. Every large technology company had a venture arm. Sovereign wealth funds were investing directly in startups. Traditional rules about valuation and governance had been abandoned. The market felt frothy and unsustainable. Founders Fund responded by becoming more selective. They passed on deals that other firms were fighting to win. They focused on companies with genuine technological differentiation rather than just good go-to-market strategies. They avoided businesses that depended on continued cheap capital to survive. They prepared for a market correction that seemed inevitable. The correction came in 2022. Interest rates rose. Public technology stocks crashed. Private valuations plummeted. Many startups that had raised at sky-high valuations faced down rounds or bankruptcy. Venture capital returns turned negative. Limited partners questioned whether they should continue allocating to the asset class. The party was over. Once again, Founders Fund saw opportunity in the chaos. Companies that had seemed overvalued were now available at reasonable prices. Founders who had been spoiled by easy money were now hungry and focused. Competition from tourist investors disappeared. It was 2008 all over again. Time to deploy capital aggressively while others were running for the exits. This pattern of counter-cyclical investing had now repeated multiple times across Founders Fund's history. They invested during the 2008 financial crisis. They invested during the COVID-19 panic. They invested during the 2022 venture correction. Each time, other investors thought they were crazy. Each time, they generated exceptional returns by acting when others wouldn't. The pattern revealed something fundamental about Founders Fund's advantage. It wasn't superior deal sourcing or better relationships with entrepreneurs. Those helped, but many firms had good networks and deal flow. The real advantage was psychological. Founders Fund had the fortitude to invest when it felt terrifying to do so. They had developed the mental models to distinguish genuine opportunities from value traps. They had the capital structure and limited partner base to support patient, contrarian investing. This psychological advantage came from their founding experience at PayPal. They had nearly gone bankrupt multiple times. They had been written off by competitors and critics. They had faced regulatory threats, technical failures, and competitive attacks. They had succeeded anyway. This gave them confidence that hard problems could be solved and that consensus views were often wrong. When things looked darkest, they remembered that they had been here before. The other source of their advantage was their intellectual framework. Unlike many investors who rely primarily on pattern matching and social proof, Founders Fund had developed clear theories about technology, markets, and progress. They could articulate why they believed certain things would happen. They could identify the assumptions underlying those beliefs. They could test those assumptions against new evidence. This analytical rigor allowed them to maintain conviction when others were wavering. Their framework started with Thiel's views on competition and monopoly. He believed that competition was for losers. The best businesses were monopolies or near monopolies. They had sustainable competitive advantages that prevented others from capturing their profits. These advantages could come from network effects, brand, proprietary technology, or regulatory protection. The key was identifying companies that could achieve monopoly status in large markets. This led them to favor businesses with strong network effects. Social networks like Facebook and LinkedIn got more valuable as more people joined. Marketplaces like Airbnb and eBay benefited from liquidity on both sides. Payment networks like PayPal and Stripe became more useful as more merchants and consumers adopted them. These businesses had natural winner-take-most dynamics. The leading player would capture a disproportionate share of the value. They also favored businesses with proprietary technology that was difficult to replicate. SpaceX's rocket technology gave them years of lead over competitors. Palantir's data integration software was built on years of development and couldn't be easily copied. These technology moats protected margins and market share. They allowed companies to charge premium prices and earn outsized profits. Another element of their framework was thinking about technological determinism versus contingency. Some technologies succeeded because they were genuinely superior and filled a real need. The smartphone displaced feature phones because it was categorically better. Other technologies succeeded largely due to contingent factors like marketing, timing, or luck. Founders Fund tried to invest in the former category, technologies that would succeed regardless of who built them because they were solving fundamental problems. They also thought carefully about regulatory risk and opportunity. Some of their best investments succeeded because they found regulatory arbitrage. Airbnb existed in a gray area between hotels and residential rentals. Stripe navigated complex financial regulations that deterred competitors. SpaceX exploited government interest in commercial space capabilities. Understanding regulatory landscapes and how they would evolve was crucial to evaluating opportunities. Founders Fund's view on globalization was more skeptical than most Silicon Valley investors. While others celebrated borderless markets and international expansion, Thiel worried about rising geopolitical tensions and the end of the globalization era. He invested accordingly, favoring companies with strong positions in the US market over those dependent on China or other potentially hostile regions. This proved prescient as US-China relations deteriorated in the late 2010s. Their framework also included strong views on education and human capital. Thiel famously paid young people to drop out of college through his Thiel Fellowship program, arguing that higher education was overrated and overpriced. Founders Fund looked for founders who had extraordinary abilities but often unconventional backgrounds. They valued domain expertise and obsessive focus over prestigious credentials. This led to investments in non-obvious founders. They backed Palmer Luckey, a homeschooled kid tinkering with virtual reality headsets in his parents' garage, who would go on to found Oculus and later Anduril. They backed Dylan Field, who dropped out of Brown University to build Figma, which would eventually sell to Adobe for $20 billion. They valued raw talent and determination over traditional markers of success. Founders Fund's portfolio construction also reflected their philosophy. Unlike most venture firms that make dozens of small bets hoping a few would succeed, Founders Fund made fewer, larger investments. They wanted to own meaningful stakes in their winners. They believed that a small number of companies would generate the vast majority of returns, so they should concentrate capital in their highest conviction ideas. This meant being willing to lose everything on some investments in exchange for owning more of the huge winners. This approach led to a portfolio that looked unbalanced to outside observers. A few positions represented the majority of the fund's value. Many investments had failed completely. But the math worked. The winners were so large that they more than compensated for the losers. This reflected a power law understanding of venture returns that many firms talked about but few actually implemented in their portfolio construction. The personal dynamics within Founders Fund were also unusual. Unlike many venture partnerships where collegiality and consensus were prized, Founders Fund embraced intellectual combat. Partners would argue vigorously about investments. They would challenge each other's assumptions. They would point out flaws in each other's thinking. This created a culture where bad ideas were killed quickly and good ideas were stress-tested before committing capital. This argumentative culture worked because it was depersonalized. They weren't attacking each other. They were attacking ideas. The goal wasn't to win the argument. It was to arrive at truth. This distinction was crucial. Many organizations confuse polite consensus with truth-seeking. Founders Fund understood that vigorous disagreement was necessary to avoid groupthink and surface hidden assumptions. The culture also valued writing and clear thinking. Partners were expected to write detailed investment memos articulating their thesis, analyzing risks, and explaining their conviction level. These memos were circulated and critiqued. This process forced clarity. You couldn't hide fuzzy thinking behind jargon and enthusiasm. You had to make specific claims that could be evaluated and later tested against reality. Founders Fund also maintained unusual compensation practices. Unlike most firms where junior partners made much less than senior partners, Founders Fund had more compressed compensation. This attracted hungry young investors who could make life-changing money from early wins. It also reduced the principal agent problems that plagued many firms where junior people sourced deals but didn't have enough carry to truly care about outcomes. The firm's relationship with limited partners was also distinctive. They were selective about who they accepted capital from. They wanted LPs who understood their strategy and would support it through market cycles. They didn't want LPs who would panic during downturns or demand explanations for unconventional investments. They viewed LP selection as crucial to maintaining their strategy over decades. This approach meant turning away some institutional investors who wanted to invest. But it gave Founders Fund the freedom to operate as they saw fit. They weren't constantly managing LP expectations or justifying their approach. They had picked LPs who trusted them to invest as they thought best. This trust was earned through years of strong performance and clear communication, but once established it was a massive advantage. As Founders Fund matured, they faced questions about succession and longevity. Thiel was in his 50s by the early 2020s. The other founding partners were of similar age. Would the firm survive its founders? Would the next generation maintain the same philosophy? Or would it drift toward the consensus that Founders Fund had always opposed? The firm addressed this by systematically developing younger partners and giving them real authority. Bring in someone new, give them capital to invest, let them make their own decisions, and evaluate results. This created a pipeline of investment talent that understood the Founders Fund philosophy because they had lived it, not because they read it in a handbook. It also meant accepting that some partners would leave. Several successful Founders Fund partners left to start their own firms. This could have been seen as a loss. Instead, Founders Fund viewed it as proof that they were developing talent effectively. The alumni network, like the PayPal Mafia before it, became a source of deal flow and collaborative opportunities. They remained philosophically aligned even as they operated independently. The biggest question facing Founders Fund in the 2020s was whether their contrarian approach would continue working. As more investors adopted aspects of their philosophy, would their edge disappear? As frontier technologies became mainstream investment categories, would they lose their advantage? These questions didn't have clear answers. But Founders Fund's history suggested they would adapt. Looking at their track record, several patterns emerged that explained their sustained success. They had consistently invested in companies that seemed crazy or impossible at first. SpaceX, Palantir, Facebook, Airbnb, Stripe, and many others were all dismissed by most investors when Founders Fund backed them. But Founders Fund had frameworks for evaluating ambitious ideas that others lacked. They had repeatedly shown courage to invest during crises when others were paralyzed. The 2008 financial crisis, the 2020 pandemic, and the 2022 venture correction were all opportunities they exploited. This counter-cyclical investing required psychological fortitude that most investors didn't possess. They had maintained intellectual independence and resisted social proof. When everyone else was excited about something, they looked for problems. When everyone else was scared, they looked for opportunities. This contrarian stance was uncomfortable but profitable. They were willing to be lonely and misunderstood if their analysis supported a position. They had focused on monopolistic businesses with network effects and proprietary technology. They understood that competition destroyed profits and looked for companies that could dominate their markets. This focus on market structure and competitive dynamics set them apart from investors who focused primarily on execution and growth. They had been willing to hold positions for many years through volatility and doubt. Their early SpaceX investment took years to pay off. Their Palantir investment was underwater for long periods. But they maintained conviction based on their analysis of the underlying business fundamentals. This patience allowed them to capture value that shorter-term investors missed. They had developed domain expertise in frontier technologies that other investors avoided. Space, defense, biotech, crypto, and AI were all areas where they built deep knowledge. This allowed them to evaluate opportunities that others couldn't understand. They competed on insight rather than just relationships or speed. They had aligned their structure and incentives with their strategy. Individual partner carry, concentrated portfolio construction, supportive limited partners, and long hold periods all reinforced their approach. They built an organization designed to support contrarian, long-term, high-conviction investing. Perhaps most importantly, they had maintained a clear sense of mission beyond just making money. They genuinely believed they were backing technologies that would expand human capabilities and accelerate progress. This mission attracted founders working on important problems and gave the team resilience during difficult periods. The story of Founders Fund is ultimately a story about conviction. Conviction that technology could solve hard problems. Conviction that most investors were wrong about what was possible. Conviction that contrarian positions could be both profitable and important. Conviction that the future didn't have to be a marginal improvement on the present but could be radically better. This conviction was tested repeatedly. When SpaceX's rockets exploded. When Palantir faced privacy criticisms. When crypto crashed. When Thiel's political views became controversial. When market corrections made their portfolios look foolish. Each time, they had to decide whether to maintain their positions or cut losses and move on. Each time, they maintained conviction. Not out of stubbornness or ego, but because their analytical framework still supported their positions. The facts hadn't changed even if the market prices had. This ability to separate noise from signal, temporary setbacks from permanent impairments, was perhaps their most valuable skill. As the firm looked to the future, they saw both enormous opportunities and significant risks. Artificial intelligence seemed poised to transform every industry, creating massive value and disruption. Space technology was finally becoming practical and economical. Biotechnology was unlocking new capabilities in health and materials. But each of these areas also involved significant technical, regulatory, and ethical challenges. Founders Fund's role in this future remained what it had always been. Find the exceptional founders working on the most important problems. Give them the capital and support to succeed. Hold through the doubt and volatility. Trust in technology's power to expand what's possible. And maintain the courage to be wrong in public while pursuing ideas that could change the world. The legacy of Founders Fund will ultimately be judged not just by their financial returns, though those have been exceptional, but by the companies they helped build and the technologies they helped develop. If SpaceX makes humanity a multiplanetary species, if Palantir helps prevent terrorism, if their biotech investments cure diseases, then their impact will far exceed their monetary profits. But even if measured purely on financial returns, Founders Fund represented a different approach to venture capital. They proved that you didn't have to follow the consensus to succeed. That you could invest in crazy ideas and generate exceptional profits. That courage and conviction could be sources of competitive advantage. That thinking clearly about the future was more valuable than having the best relationships or moving the fastest. For entrepreneurs, Founders Fund offered something rare. A partner who would support truly ambitious visions. Who wouldn't push for premature pivots or exits. Who understood that building important companies took time and involved setbacks. Who brought strategic thinking and network connections beyond just capital. Who shared their mission to accelerate technological progress. For the venture capital industry, Founders Fund demonstrated that alternative approaches could work. That consensus thinking was often wrong. That following the herd led to mediocre returns. That the best opportunities were usually contrarian. That courage and independent thinking were underrated. Their success gave permission to other investors to think differently and take risks. For society, Founders Fund's impact was more ambiguous. They had backed companies that created enormous value. SpaceX reduced space launch costs and revived American space capabilities. Palantir provided crucial intelligence tools for national security. Their biotech investments advanced medical research. But they had also backed controversial companies and technologies. Palantir's government contracts raised privacy concerns. Their support for crypto enabled financial speculation. Their investment philosophy prioritized disruption over stability. The question of whether Founders Fund made the world better or just themselves richer doesn't have a simple answer. They created significant shareholder value. They employed thousands of people. They funded important research and development. They accelerated technological adoption. But they also contributed to inequality, disrupted industries, and supported technologies with uncertain consequences. What's clear is that Founders Fund operated according to a coherent philosophy. They believed that technological progress was the primary driver of human flourishing. That innovation required disruption. That ambitious visions required patient capital. That consensus was usually wrong. That competition destroyed value while monopolies created it. Whether this philosophy was correct remained to be seen. As we reach the end of this story, several lessons emerge from Founders Fund's history. First, having a clear analytical framework matters more than having the best relationships. Founders Fund's theories about monopoly, network effects, and technological progress guided their decisions. These theories could be wrong, but they were testable and refined over time. Second, psychological fortitude is a competitive advantage. Most investors cannot invest during crises or hold positions through volatility. The ability to control fear and maintain conviction when others are panicking is rare and valuable. Founders Fund developed this capability through experience and institutional design. Third, mission matters. Having a sense of purpose beyond making money attracted better founders, motivated the team through difficulties, and provided a framework for decisions. Founders Fund's mission to accelerate technological progress was genuine and influential. Fourth, structure enables strategy. Founders Fund's individual partner carry, concentrated portfolios, and supportive limited partners all reinforce their contrarian approach. Trying to implement their strategy with a conventional structure would have failed. Fifth, domain expertise creates opportunities. By building deep knowledge in frontier technologies, Founders Fund could evaluate investments that other firms couldn't understand. This expertise compounded over time as they learned from each investment. Sixth, intellectual honesty and clear thinking are essential. Founders Fund's culture of argumentation and written analysis forced clarity. Bad ideas were killed quickly. Good ideas were stress-tested. This process wasn't comfortable, but it was effective. Seventh, timing matters but is difficult. Founders Fund benefited from starting when competition was low and continuing through multiple market cycles. Their counter-cyclical investing exploited market timing. but predicting exact entry and exit points remain difficult. 8th, conviction requires courage. Being right and unpopular is harder than being wrong and popular. Founders Fund repeatedly took positions that made them look foolish. Sometimes they were wrong and looked foolish. Sometimes they were right and got rich. But the willingness to endure being wrong in public was necessary to capture their best opportunities. The ultimate lesson from Founders Fund story is that investing is about seeing the future before others do and having the courage to back your vision. This requires analytical frameworks, domain expertise, psychological fortitude, aligned incentives, and a sense of mission. It also requires luck and favorable timing. But those who develop these capabilities can generate exceptional returns while building important companies. As Founders Fund enters its third decade, the venture capital landscape has changed dramatically from when they started. More capital is chasing deals. Valuations are higher. Exit timelines are longer. Regulatory scrutiny is increasing. Competition is intensifying. These challenges will test whether their approach continues working. But if their history is any guide, they will adapt while maintaining their core principles. They will continue backing ambitious founders working on important problems. They will continue making contrarian bets that seem crazy at first. They will continue holding through volatility and doubt. They will continue trying to accelerate technological progress. And they will continue believing that the future can be radically better than the present if we have the vision and courage to build it.